What's up, gold miners? Today we welcome Steve Blackwell to the program. Steve is the CEO of Invito Energy Partners, an upstream oil and gas investment firm. Invito Energy primarily invests in non-operated working interest wells, targeting Tier 1 acreage across 6 major U.S. oil basins. And in this episode, Steve really starts to peel back the layers of complicated jargon so that investors like me and you can start to really understand oil and gas, not just as an investment, but the actual semantics behind the business of oil and gas as well. To kick off the episode, Steve dives into the fundamentals, the inner workings of the oil and gas industry. And then he gives an in-depth overview of upstream oil production, which is what his fund predominantly invests into. Later on in the episode, Steve gives us his LP investor checklist. What are the things that you as a limited partner should look out for when getting ready to make a direct investment into an oil and gas opportunity? And then finally, we conclude the episode with Steve giving an in-depth overview of the tax advantages associated with investing into oil and gas. Be warned that many of the oil and gas investments that are out there don't even qualify for these tax advantages, so it's important to know what kind of opportunities you should be investing into in order to qualify for the max amount of tax advantages that oil and gas has to offer. You guys know that I am an absolute sucker for tax strategy. I could talk for days about that, and Steve and I, we really spend a lot of time at the end of the episode going in depth on tax strategy and tax advantages. So needless to say, I had an absolute blast, and I know that you would get a tremendous amount of value by listening to this episode, especially if you've never made an oil and gas investment before. You're going to leave this episode with a tremendous amount of knowledge that will equip you if you ever decide to make that kind of investment in the future. So without further ado, everyone, let's welcome to the show, Steve Blackwell.
The Gold Mine Podcast.
Steve, welcome to the Gold Mine.
Happy to be here. Thanks, Danny.
And man, I'm excited to have you on. And you know, we've had a few oil and gas guys on the show, but I think it's one of these niche investment classes where, you know, people have heard about investing in oil and gas, right? Like, oh yeah, you know, I've heard of it, but it seems probably for like the average investor, right? The average S&P investor, the index bros, probably something that they don't really know a lot about, right? So
yeah, how
does one, you know, start investing in these types of, into this type of like alternative investment, right? Like if someone wants to like invest into oil and gas, where should they start?
Yeah, I mean, I think it's important to recognize, like, if you're a believer in the energy sector, or the more specifically, whether it be the oil and gas sector, right? You can obviously invest in publicly traded entities, right? So you could look at the upstream companies, which are the companies that drill the wells. You could look at the midstream companies, the pipeline companies, which are great income plays, right? And then you could look at the downstream companies, which is where all the refining of the product is done. So ETFs, publicly traded companies, those are ways to invest directly into the energy space. If you're going to invest direct, meaning going directly into owning the physical asset, the most common way for retail investors is into the upstream side, which is directly into oil and gas wells. And so that's kind of and the two categories there are what's called working interest investments and royalty or mineral interest. So the two most common. And I could explain that further if you'd like me to.
Yeah, well, what would the difference be between those two approaches?
Yeah, so if you're investing into what's called working interest in a well, it's akin to equity in a well. So if you're a working interest owner in a well, let's say that you own 10% of a well, you are responsible for 10% of the capex. So to make the math easy, let's say it was a $10 million well, then you're responsible for $1 million of that. And then you're responsible for your portion of the monthly operating expenses. And then you receive your proportionate share of the revenue, when you're a working interest owner. If you're a mineral owner, mineral owners get paid off the top. So if I own royalty rights or mineral rights, which basically converted to what's called a royalty. So for example, let's say that, Danny, let's say you owned all the minerals on a location where someone was drilling a well. And I, as the operating company or as the oil and gas company, came to you and said, I want to lease your land and I want to lease your minerals because I'm going to drill a well here. The negotiation points there are how long is the lease for? how much you're going to pay me per acre. But the most important one is what is the royalty rate that you're going to get paid? And that royalty rate typically averages somewhere between 15 to 25%. It's kind of a standard range in oil and gas. So let's say that you had a 20% royalty. So as a royalty owner, you don't pay any of the CapEx, you don't pay any of the monthly operating expenses, and you get paid first. So let's say, for example, in 1 month, there was $1 million of revenue. You as the 20% royalty owner would get 200 grand straight off the top. You get paid first. Then the 800,000 is what's left over. Then you take the 800 grand, pay the monthly operating expenses. That net revenue is what gets paid out, distributed to all the working interest owners.
Yeah.
So royalties typically trade at a higher valuation because they are subject. You're obviously paying no CapEx, and you're not paying any of the monthly operating expenses. And you can buy royalties or working interest in wells that are already cash flowing, or you can buy it into wells that have not produced yet, if that makes sense.
Yeah. Yeah, absolutely. Well, and mineral rights, correct me if I'm wrong, right? But just because you own the mineral rights doesn't necessarily mean that you own the land, correct? Like those can technically be siphoned off, right? Like you can own the land, but not the mineral rights, and vice versa. Yeah.
So it's very common for surface rights and mineral rights to have been separated over time. So you have a completely different, and it's very common when you go to drill a well that the mineral owners are different than the surface rights owners. And so you have to negotiate different types of agreements with the surface rights owners to get, access to the land to drill the wells, versus what you negotiate with the mineral rights owners. So yes, they're sometimes they're the same, but many times they're separate.
Yeah. Okay. So, and your company, which is in Invito Energy Partners.
Yeah, Invito
correct?
Energy Partners. Yep.
Invito. So you're predominantly upstream.
Yes. 100%.
And are you? Which one of those two buckets do you guys kind of fall into? Is it a little bit of both, or do you predominantly focus on one of the two?
Yeah, so we predominantly focus 100% into acquiring working interest in wells that have not been drilled yet. So we are not acquiring working interest in wells that are already cash flowing, which is called PDP in our industry, proved, developed, producing. We are acquiring working interest wells that have not been drilled yet. And the reason we do that is that's the one out of those four I told you where you can acquire working interest or mineral rights and producing or not producing wells. The only one that has the significant tax benefits associated to it is acquiring working interest in wells that have not been drilled yet. That's 100%.
And correct me if I'm wrong, but the reason behind that would be if you haven't drilled yet, you're not 100% sure if that well is going to produce any oil, right? Or you're not kind of take me through that, right? Like my understanding is that like until you drill, you're not 100% sure, right? So until you've kind of gone through that process, and that would be the reason, well, like that's why the government incentivizes you to do, in that way. Is that more or less the case?
Yeah, I would say the government incentivized, like Congress does, right? They use the code to incentivize capital to flow to different areas, right?
Sure.
So these incentives were put in place, 4 or 5 decades ago. And really, if you're old enough like I am, you'll remember that 25 years ago, the United States is producing maybe 3 to 5 billion barrels a day of oil. So it was, and the United States consumes around today, it's about 22 million barrels a day, but around that time it was 20 million barrels a day. So the United States was so dependent on foreign oil or foreign imports for a very long time. So if you're old enough to remember the 70s where we had the oil embargo and long gas lines. So Congress has put in incentives in the code to get capital to flow to the development of hydrocarbons in the United States. And they just have never changed them. And so, from a audit standpoint, there's tons of case law on these types of tax benefits. They've been around forever. They get kicked around every 4 years in Congress, like if they're going to take them away, but they don't, they just never have done that. So, they're old standing laws that have been around, and there's two primary ones that are specifically for oil and gas. So I would say the reason why the government put it in place was to get capital to flow to the development of hydrocarbons in the United States, because we were just so dependent on foreign oil for such a long time. Really until not the last two decades ago when the oil and gas industry changed with the development of what's called horizontal drilling and fracking technologies that really opened up a bunch of new basins in the United States.
Interesting. So what you're saying basically is that more than anything, they're trying to incentivize new well creation, correct?
Yeah, they basically wanted capital to flow to drill wells because they wanted more, domestic production because we consume so much, produce so little, which that's changed today drastically, right? I mean, most people are really unaware that, in 2024 we surpassed 13 million barrels a day of oil production in this country, which made us the largest producer in the history of the world. And we're still consuming 22 million barrels a day, but as it stands today, the United States is the largest producer of oil in the world, even beyond Saudi Arabia. So most people are unaware of that. And that occurred under this shocks most people as well, but that occurred under a Democratic administration as well.
Yeah.
So,
I did know that.
Makes sense of that one, right?
Yeah. No, I did know that we are now technically the number one oil producer in the world. And my understanding too is that the United States is actually, well, at least on paper, right, like the most oil rich country in the world, right? Even more so than Saudi Arabia.
Yeah, I mean, there's a lot of debate probably on reserve analysis in terms of what's still left in the ground, but we're definitely near the top. So, the industry has done an amazing job over the last 2 years with all of the technology advancements in terms of how we drill the wells and how we produce the wells out of the basins underneath the earth. So it's kind of an amazing feat of the industry.
So, coming back to the way that Invito works, you are investing in primarily, basically building these wells, right? Like, or building is that what we call them? We call them wells, we call them pumps, drills.
Drilling the wells, yeah.
You're drilling the wells, yeah.
Yeah, so we are acquiring working interest into, so every well that is drilled. So my background was an executive running upstream oil and gas operating companies, where we were the operator of record on the projects that we were managing. But when you drill a well, there's always a company, the operator of record. That company is the one that's required for filing the permits to drill the well, managing all the vendors that come on location to drill the well, complete the well. It's that, operator's job to then pay all the expenses, pay all the working interest owners, royalty owners, do all the state and federal compliance for the well, right? But what's interesting about onshore wells in the United States is very infrequently which is unique to oil and gas, the operator rarely owns 100% of the working interest or equity in a well. So there's what's called the whole secondary market, if you will, of what's called non-op working interest that's traded or that's acquired, bought, and sold. And so what we specifically do is we are mostly acquiring working interest in wells where we will not be the operator of record. So for example, like tomorrow, we're closing on a package where we'll be in, a 3-well package with a company called EOG, which is like one of the top 10 E&P publicly traded E&P companies in the United States. And so EOG is not letting me in their wells, but I'm acquiring the working interest they don't own from somebody else. And so what we specifically do is acquire working interest in wells that are being drilled by the larger E&P companies. And the reason we do that is really from a risk management standpoint, because what I would call from a layman's turn point, without getting too technical for your audience, but the most de-risked or proven up wells where you don't have the downside risk of potentially drilling wells where you could produce nothing, which is very common in oil and gas for certain type of projects. If you want to stay away from those type of projects and you want to focus on what we would call tier 1 acreage in oil and gas, most of that, 90% plus of that is owned today by the larger E&P companies in the United States, since we've had so much consolidation in our industry. Yeah. So as a fund manager, which is what we do now, we are a fund manager who raises capital primarily through relationships with CPAs and financial planners who have high net worth clients, who have a lot of active ordinary income that are looking for alternative investments, looking for tax strategies, looking for uncorrelated assets. They don't want that downside risk. So if you talk to an investment advisor, the number one thing they will tell you is, don't lose my client's money. So if you're if you want to eliminate that downside, you don't want to participate in projects where the spectrum of returns could be 0 to a 4 or 5x and anywhere in between. So that's primarily what we do.
Got it. So prior to starting this fund,
yeah,
I imagine, Steve, that you and or some of the managing partners had experience in the oil and so like how did you find your way into this? In other words, what makes you qualified, to be the expert to identify these opportunities?
Yeah, I was the president of a company called Petromax Operating.
Okay.
And so when we were at Petromax, we were the company that would go out and do the geology work into an area. So we would be invested into what I would call the tier 3 acreage areas where there was a lot of exploration risk, right? So we were drilling the first wells in these areas in terms of whatever we were doing. But we would go do the geology to understand whether we think the hydrocarbons are there and if they're there in paying quantities. Then we would go do the land work where we would, particularly what we did is we'd lease up 15 to 20,000 net mineral acres, put a position together, and then we would drill enough wells. All of these were horizontal well projects. We would drill enough wells, typically 15 to 20 wells, to where we could prove up the acreage, and then we would sell it up the food chain. So that was a great business strategy for about 15 years in our space. There was a lot of these basins were new. There was lots of private equity in our space and or publicly companies you could sell up to. And so we did, when I was the president of Petromax, we did 3 operated projects and 2 non-operated projects. Those assets sold for about $1.3 billion. One of the last projects we did, I took some money off the table, had a 2-year non-compete, sat out for a couple of years, came back into the space, and went to work for a company who raised money in this space through what I would call the financial planner network. Really was primarily what's called the broker dealer, which is what opened my eyes to the space of raising capital. Through this channel. We don't raise money through the broker dealer channel, mostly because the fees are too high if you go down that route. We raise money through what's called independent fee-based registered investment advisors. So between myself and my partner who ran ops for me at Petromax, who I took with me to the other company, and who also has been an engineer right out of school, been in the industry for over 20 years. We've deployed collectively, but between ourselves, we've deployed over $1 billion of capital. And, Jared's drilled wells in every major basin in the lower 48. So the size of the projects we're doing now are much smaller than what we used to do.
Yeah. That's super cool, man. I mean, so it sounds like you've got, quite a rich history kind of like coming into this business and in creating Invito. And it's interesting, right? Because like as a fund manager, it's, your job is to de-risk, right? Essentially, right? Your job is to figure out, okay, well, what is the best investment with the lowest risk possible? Obviously risk is inherent in every investment, right? But like your job is to particularly find investments where the upside is strong, but the downside is fairly nominal, right?
Yeah.
You already mentioned it. So you partner with experience or you partner with some of the more like the bigger fish, right? So to speak, so that you're kind of de-risking in that way where they've got, plenty of systems, processes, experience.
Yeah. They have a huge technical team. They've typically spent already hundreds of millions of dollars in these areas to de-risk them. So part of what we underwrite when we look at a prospect is the operator. Not that small operators are always bad, but the average horizontal well is $8 to $10 million. So, the capital behind the company is very important, as well as the technical experience and the size of the technical team. So one of the advantages of being a non-op is I don't have to go build a big operating company anymore. I don't, because I'm not the operator. I don't have to have near the size of the company. So essentially what we're doing is basically taking our skill sets and going out and just picking and choosing the wells that we would invest into ourselves and doing that for other people. So, but underwriting the operator is as important as we're underwriting the asset when you're looking at a prospect.
Yeah. You said that to build a well is going to be like $8 to $10 million. On a drill or site of that size, what are the typical like operating costs in a year?
Well, you mean what does it cost to operate it after it's flowing? So once a well is online,
correct. Once it's up and running, Once
Yeah.
it's up and running, what are the typical operating costs on a yearly basis?
Yeah, I mean, it could be, so how they look at that is on a per barrel price. So they call that lifting costs, right? So your lifting cost could be anywhere from $15 to $30 a barrel, right? It just depends on where you're at. So if you think about it, if your price is, you're selling it at $65 a barrel and your lifting costs are $20 a barrel, and that's your margin in between in terms of profit. So then all that's part of the underwriting, right? I mean, so when you're doing the underwriting, here's what drives value in a well, right? What's it going to cost to drill the well? What's it going to cost to operate it? In other words, what are those lifting costs after it's producing?
Yep.
Then what is the production? So what in oil and gas, they call it the EUR, estimated ultimate recovery. So the EUR in a well may be half a million barrels of oil. But more importantly is, what does that production curve look like? So what does it come on at, initial production rates, and what's the decline rate look like? So that's what the job of the reservoir engineer is, to go in and determine, when they underwrite an asset, what's it going to cost to drill it? What's it going to cost to produce it? What is that production curve going to look like? And then, of course, you're always making assumptions on commodity prices. And so those are really the 4 KPIs, if you really wanted to break it down, that will affect your return profile on a well. If you blow out the CapEx, you think it's going to cost $10 million to drill a well, and it ends up costing you 12, it's going to hurt your returns. If you think the lifting costs are $15 a barrel and it costs you $30 a barrel, it's going to hurt the returns.
Right.
If you modeled out oil prices at X and they're Y, and Y is either less or greater, obviously it's one way or the other, right? That's going to affect the returns. And then, of course, if you think a well is if your engineers are consistently statistically off in any substantial amount, like they are always 10, 20% off, they think a well is going to produce 500,000 barrels and they're always too high, right? Then your reservoir engineers are too aggressive, right, in their modeling. And so those are all the things you pay attention to when you're running an oil and gas business, especially when you're doing the underwriting of an asset. So it's a just so you know, for you and your audience, man, oil and gas is an extremely technical business. I mean, what I am talking about is very high level. I mean, there are so many disciplines within the oil and gas industry. I tell people all the time, if you are ever looking at oil and gas private direct investments, you have to look at the team deeply in terms of what their experience is. And so what I would say to people is always stay away from the people that are just money raisers, right? There are lots of people that raise money for oil and gas that are not oil and gas people, don't have technical experience in oil and gas. Because just on the engineering side, you have reservoir engineers, you have drilling engineers, you have completion engineers, you have production engineers, you have geologists, you have geophysicists, you have the land people, so much go. And these people all have, 4 bachelor's or master's degrees, right? And they've got tons of years of experience is what you want, right? Because the best way you learn in oil and gas is by drilling wells, right? So, and experience. So it's an extremely technical business.
Yeah. And honestly, like the only technical experience I have with oil and gas is Landman. I've watched a few episodes. That's about it.
I got asked about that movie so many times that I finally had to break down, or that show, I finally had to break down and watch it. Which, by the way, it's a great show, and Billy Bob's awesome in that show, right? But I think in the first two episodes, 3 people die on location, right? My wife looks at me and says, I'm like, that's not what this is not oil and gas. Nobody would invest in oil and gas if, people were blown up on rigs and dying on that frequent of a basis, right? Or, the cartels kidnapping your landman or your, most of your employees are, ex-convicts. I mean, they got to make it fun to watch, right? But there's very, very little about that show that is realistic, other than some of the terminology, obviously.
Yeah, no, that's great.
It's a great show. I mean, it's just an absolutely entertaining show to watch.
Taylor Sheridan is dude. He's one of the best right now. I mean, he's got so many great shows.
Yeah, there are so many one-liners in that movie. You could just literally write a book on it. Yeah, and I think Billy Bob's whole rant on clean energy in there was like, I just like to, copy that and post it on our website.
Yeah. Yeah, no, it's got, after watching that, I was like, man, this is, I can't wait for season 2. It's going to be a good one.
Yeah.
It's going to be good. But man, there's a couple of different directions I could take this right now, Steve, because you said a couple things there as you were wrapping up that last thought. So let's take a step back here. When looking at, when looking at oil and gas as an investment,
yes,
right? What are as a passive investor, you're investing direct into these deals, like you said. What are the things that the investor should be looking like? What are the things that a layman that doesn't really know the industry? What are the few things like on the checklist then to kind of go through and vet a deal with like low levels of expertise?
Yeah, I would say the same thing you do at pretty much any private placement is. First is you need to look at the team, right? You have to, even if you're doing commercial real estate, right? You have to look at the team. If you're looking at someone who's if somebody's doing a pitch in a self-storage deal, well, do they have experience in self-storage, or is this their first or second deal? And they used to do something totally different, right? What I'm telling you in oil and gas, this is not self-storage. This is we're drilling holes into it. If the team doesn't have deep oil and gas background, I'm going to tell you right now, pass. Okay. The second thing I will tell you is the thing that nobody wants to do. They don't want to do this at any private placement deals. They don't want to go read a PPM. I get it, because the lawyers make them 200 to 400 pages long, and 3/4 of it is BS and doesn't matter. It's all legal disclaimers, but there's always 20 to 40 pages of pertinent information in a PPM that's most important. And what I would tell everybody in that is understanding, I don't care if it's real estate, I don't care if it's oil and gas or whatever it may be, understanding how the sponsor is making money and how much of that money is up front, and does it align with how you make money? In other words, what you don't want to get into, this happens in real estate deals, man, where you see that there is such a promote on the front side of the deal that the reality of it is, even if the project doesn't go well, the sponsor still makes a hefty amount of money.
Yep.
And I personally, as a guy who does a lot of private investing, I will never touch a deal like that. I'll never touch a deal as well if I can't understand how they make money. If it's too complicated, and as I'm reading the PPM, I can't figure it out, or I'm having to follow defined terms from page 4 to page 50 inside a PPM to figure out how their fee structure is, I'm out. I'm out. If they can't make it simple for me, I'm out.
Yep.
For oil and gas, those are the two most main things I would tell you, because otherwise, if I'm going to tell you to go try and understand whether it's royalties or working interest. And working interest has unbelievable tax benefits when you buy into working interest on new wells. And so that'll be a given in the deal. You're going to get unbelievable tax benefits, but people get lured in by tax benefits and don't realize it's an investment first. But if you think that as an oil and gas person, you're going to go do the due diligence on the project, of the type of project they're doing, it's not going to happen. So you're going to have to learn, you're going to have to look at the background, trust the people doing it, that they have the technology and expertise to do it. But then as equally as important is, how are they getting paid? How are they making money? Yep. Does it matter the quality of assets they get into? And I see a lot of oil and gas deals. Actually, it's the norm. The most oil and gas deals I see that are out on the street, there are so many fees in the front side that the sponsor is making money regardless of the quality of the project. And that's the kind of stuff I would stay away from.
Yeah, no, that does make a lot of sense. And I know the fee structure in oil and gas is definitely like a little bit different than it is in the real estate world, right? So what would you say and by the way, again, this isn't like an investment offering. But what would you say like a typical fee structure looks like if you were to kind of just take a bird's eye view and typical?
Well, look, it's just in oil and gas is typical that there's what's called an upfront fee and a back end fee. So, there's upfront fees in oil and gas that are going to reduce so whatever dollar you give, there's going to be upfront fees, meaning let's say it's 10%. So if it's 10% upfront fees, meaning 9 cents out of 10 of 90 cents out of a dollar goes into acquired assets. So you want to know what that upfront fee is. Then there is typically another set of fees where they're there are different terms for it, but you could call it a revenue share, carried interest in the fund, and where the investor, when you start to make a distribution, right, the investors are going to get X amount and the sponsors are going to get Y. So you want to know what those are. And then that is very common to have a back end carried interest. In other words, if a sponsor's carry in the fund is, just to make it easy, let's say it's 5%. And then after payout, meaning after an investor gets all their money back, that typically goes to a different number. It can go to Y. It could go from 5 to 20 or 5 to 25. But most important to understand is the upfront fees. How much of your dollar is going into the asset, right? Which is the upfront fees will reduce that. And then how much of the revenue from the $1 is coming to you. And I was just reading there's a guy on LinkedIn that does a lot of LP commentary and LP investment advice. His most recent article was on investors that get hooked on prefs, right? They see the word pref and they think that, oh, this is the greatest deal in the world. And so prefs are great marketing tools is what I'll tell you for sponsors, right? Because everybody likes a pref. Well,
sure.
Depending on the pref, sometimes you are the pref.
Yeah.
I hate to tell you that. The yield, you are the pref. The money's coming out of your money. And other times the pref is just a way to window dress the economics so that the sponsor makes more money on the overall deal. So I'm not saying that on every deal, but it's just stuff you need to understand.
Yeah. No, that's very true. I mean, because pref is only like one part of the equation, right? Like if there's a massive like upfront acquisition fee, and then, I don't know, I'm assuming there's like asset management fees too in oil and gas, right? Like there's some
there could be a great point. There could be AUM fees. There could be disposition fees, acquisition fees. I mean, again, this is why reading the PPM is so important. Reading the PPM, and I hate to say this, the operating agreements, which are painful, but to do. But you just really want to read those, or look at the addendum up front to see the subjects that are on fees, right? So that you get a good idea of where you're being charged. And so that's equally important. But my favorite is, we're going to pay you 10%, annual 10% distributions from the get-go, right away. Where do you get the money? Yeah. How do you do that?
Yeah. Exactly.
I mean, they're just paying distributions out of investor raised capital. That's the comment that you are the yield, right? I mean, how do you have distribution? How do you have a yield of 10% before your assets are even acquired, invested, and start producing? So when you see the deals that are, it's a 10% annual from year one, day one, wonderful. How in the world do you have the money where's the money come from? It's just investor money being recycled. And so those are just things I'm just telling you, as a sponsor, it's way easier to raise money if I can tell people, you got to guarantee 10%. I got a pref of 8%, a pref of 12%. Those are buzzwords that everybody likes. They're not always necessarily beneficial to you. There are great ways to raise capital.
Yeah. I know that. I mean, it is a good point. It's a really good point that you got to be really careful. The one thing I will say though, Steve, and something as you were kind of like saying all of that came to mind is one thing that I've been doing recently, because a lot of these PPMs, a lot of these materials that get sent out, you said operating agreement, you can actually now build out bots within ChatGPT to help
you could dump them entirely into ChatGPT now.
Yeah. Which
is
them to
read
cool.
it for you to get the fees.
Yeah, exactly. Am I getting screwed? Yeah.
Or it's amazing what you can do it's amazing what you can do at ChatGPT plus the other ones. But yes, you can absolutely. I watched a webinar where the guy walks through how to do that. But you could absolutely do that. You can just dump the document in there and ask it questions.
Yep.
So, it doesn't hurt to do that as well.
100%. Yeah. And one last thing on the pref too. It's like, with all the fees that are in there, there are sponsors, and I've seen this before where like, the pref might be, 6, 8, 10% or whatever, but like they're making 5 to 7 or 8% in fees before the pref is paid out. So it's like, that's not really a pref, right?
Yeah.
Like it's,
No.
the fees are eating away. You're not going to make your pref, buddy. I mean,
there's nothing wrong with doing it. Not that I've ever invested in something with a pref, but I'm just telling you, it's not that it's always this great thing for the investor, other than you could count on it. But, there's just a bunch of additional questions to ask when it's like that. We don't do prefs on our deals because it's very difficult to know a gas to make sense of that. And ours are simple for us. It's very simple. Wells come online and we distribute all the revenue with a split ratio, and that's it. So there doesn't need to be a pref, because if I was window dressing that with a pref, I would be doing some creative spreadsheet work behind that. And it don't need to do it.
Yeah. So you, switching gears a little bit here, Steve, at the beginning of the episode, we talked about your investment thesis kind of being the one of the 4 upstream methodologies that qualifies for the tax enhanced tax advantages, right?
Yes.
So I want to talk about this because I think it's something that is, not talked about enough, which is, the inherent tax advantages of investing into oil and gas. So what are the tax advantages that you're referring to there?
Yeah. So the big tax advantage write-off for oil and gas is what's called the IDC deduction. So a lot of times you'll hear funds that are called IDC funds. IDC stands for intangible drilling costs. Okay. So it's IRC section 263C of the code if someone wants to look it up. But essentially what it says is that you could take 100% of the intangible drilling costs and take them as a loss in the year of investment. So what's an intangible drilling cost? When you drill a well, anything that goes into the ground to drill that well that has no potential salvage value when the well is done and plugged, that's what the IRS defines as an intangible drilling cost. And when you drill a well, typically the IDCs range somewhere between 75 to 85% of the total cost of the well. So just pick the middle number, 80%. If you make a $100,000 investment and your IDCs for that year were 80%, you're going to have an $80,000 loss that's going to show up on line 13 of your K1. And that loss can flow through to your Schedule E, to your 1040 to offset ordinary income. So but and I don't know if you heard that last part.
No, I didn't.
I know you guys do a lot of
someone came in here and
What's all right. Right. I saw the symbol behind the scenes.
Yeah.
You guys do, I think your audience is a lot of real estate people, right?
Yep.
So a lot of people do real estate and when they want to get big tax losses up front, right? First off, it's either they have to qualify as a real estate professional or if it's short-term rentals, they got to prove material participation. And then they'll go get a cost seg study, right? And they'll get a big depreciation up front or whatever that number is.
Right.
Oil and gas, it's a similar concept. Essentially, when you're taking 100% of the IDCs, you're depreciating the asset up front. It's just called an IDC deduction, right? But you do not have, even though this is 100% a passive investment, there is an exception in the passive actor rules specifically for working interest that allows you to take that loss and offset ordinary income. So now you know why financial planners, wealth managers, CPAs love this investment. There's nothing to do. You don't have to qualify as a real estate professional. You don't have to go get a cost seg study. You don't have to prove material participation. You just make the investment.
Right.
You get this big loss in your K1 that can offset if you're a doctor, a dentist, a high-paying tech job, anybody with a high-paying W-2 job, 1099 job, or any business owner that's anybody kicking off a lot of ordinary income on an annual basis. But as you know, especially the W-2 people, which there's so very few things you can do for high-paying W-2 people. This is a binary investment. It has a great upfront tax benefit. And then, of course, it's an investment as well. And the investment thesis is no different than commercial real estate in the sense of when you're investing in commercial real estate is because you're looking for alternative assets. You're looking for risk management strategies inside of your portfolio because it's not traded on a daily basis. It's uncorrelated to the equity in the bond markets. If you had a 50% of your portfolio in alts those last 60 days, you were not, reaching for the Pepto-Bismol like everybody else was when all the Trump tariffs made the world, go crazy. Right.
Yeah.
So, or 2022 or 2008, when you get these massive drops in the equity markets, that's one of the main purposes of alts, man, is they smooth out volatility in a portfolio. Now the conundrum is most alts are not liquid, right? Like stocks and bonds, but the big upfront deduction is the IDC deduction, that you can take 100% of those costs and write them off and take that loss and offset ordinary income. So it's a great strategy. We see people use it in Roth conversion strategies. We see people with high-paying W-2 jobs, people that have one-time events. They sold some stock, got some stock options, sold a business, sold an asset, whatever it may be. They just have a tax bill, and they're looking for ways to reduce that taxable income. And then the other tax benefit that comes with oil and gas is called the depletion allowance, and essentially, or small producers tax exemption. So as this cash flow comes back to you, you only pay tax on 85% of it. 15% of it passes tax-free, passes through tax-free. So those are the two codes that I referred to earlier that have been in the code for, a number of decades to incentivize cash flow to go to capital to flow to oil and gas.
So just to get that right, to get that straight, 75 to 85% of the initial investment is technically a write-off.
Yep. Well,
and then in perpetuity, the cash flows that are generated by the well are going to be at a discounted rate of about 15%.
Yeah, you only pay tax on 85% of it. 15 is tax-free.
Gotcha.
Yep.
Gotcha.
Then the remaining cost of the well, the tangible costs, so the other ones were intangibles. Tangible costs are the other 15 to 25% of the cost of a well. That's anything that goes into the ground that has salvage value, pipe, casing, production equipment. Those are typically amortized over 5 years, or you can take bonus depreciation, just like any other industry, and accelerate those either in the year of investment. The caveat with oil and gas is you can only accelerate them in the year of investment if the wells were also drilled that year, or you'll take them the following year. So, obviously the TCJA is sunsetting, so you can only take 40% of those this year, but
we'll see.
I'm pretty sure that's going back to 100%. Yeah. I would bet any amount of money that at the bare minimum, the TCJA just gets extended and puts bonus, which would mean bonus depreciation goes back to 100%. I mean, the House bill that just came out, it definitely has it in there, but the House bill also has a bunch of other stuff in there that may or may not survive the Senate and the reconciliation bill. But the TCJA is already part of a budget. As a bare minimum, that's going to get extended.
Yeah, I would expect that to go away here pretty soon. So
you technically, if you are investing into a fund in 2025 that's early enough, you could get theoretically a 90 to 95% deduction for 2025.
Interesting, because of the all of the other
because you could take
items,
bonus depreciation on the tangible portions of the cost too, versus waiting until 2026 to take them.
It's very, very interesting. So for an LP into your fund, Steve, how does the fund pass along? Like, does it just directly pass through the fund, or how do those tax benefits kind of get? I mean, it just shows up on your T1. I mean, all the tax benefits flow through the unit holders. And so just so you know, gotcha. every oil and gas fund is set up the same way if it's done correctly on this regard. You come into, if you're going to offset ordinary income, typical oil and gas wells are set up as limited partnerships. You come into it as a general partner. So the caveat for the IRS is that you come in at risk. Right. That's what that little caveat is saying, that you can offset ordinary income. So you come in as a GP, and the way it works in our fund, but it's the way it works in pretty much every fund I've ever read. You convert to a limited partner once the wells are drilled, which will typically happen somewhere between month 12 and month 16. And it's typically written right into the partnership agreement. So it's an automatic conversion. So that's how you come in. Now you could come in as an LP from the get-go if you needed passive losses. So let's say you had a bunch of passive income that you needed to offset, you could come in as an LP.
but you have to come in as a general partner to offset the ordinary income, which means you have to invest as an individual. You can invest to like a revocable trust, but what you can't do is invest to like an LLC or an irrevocable trust.
Sure.
That'll kill the ability to offset ordinary income.
Interesting. Okay. Now, on the same subject, right? Because I'm sure that, and it sounds like you even work with CPAs to kind of source retail investors too.
We do, absolutely.
But I'm sure that you've realized or recognized at this point that CPAs come in all shapes and sizes, right? Knowledge bases. And what can you say or what's the advice that you'd give to like an investor who, maybe has a CPA that doesn't really work to strategize, right, on their behalf and just kind of like puts the papers together, right, so to speak?
Yeah.
Because we're talking about tens, if not hundreds of thousands of dollars in savings. And I'm sure that you've noticed, right, like some of your clients, they probably come to you and their CPAs are absolute garbage.
What I would say to anybody listening to this call or watching your podcast is, if you are a person who makes, if you're hit, first off, you have to be an accredited investor to invest in our fund, which are most, private placements, which, that's $200,000 annually, $300,000 if you're married, or $1 million of net worth, which is not the highest bar, to be honest. But if you're in the higher income brackets on an annual basis, if you're in the 35 to 37% income tax brackets and your net worth is north of $1 million, either find yourself a financial advisor that engages in tax strategy, or find a CPA firm that engages in tax strategy. You don't have to have both. You just need one of them to do it. Mm-hmm. And those are not, most tax CPAs are tax preparers. They're not tax strategists. But there are firms out there that are absolutely on the tax strategy side as well as the tax prep side. So they'll have two sides of their business. They'll have the guys that are focused on tax strategy, and they'll have the tax preparer side. Mm-hmm. And then in terms of the financial advisory world, right, the reality of it is the majority of financial planners don't engage in tax planning, but there are holistic financial advisors out there that are going to look at everything, from your estate planning to your next gen planning to your tax planning to your insurance planning to your investment planning, the whole 9 yards. Mm-hmm. So you can either try and do it all yourself, or you can go find someone on one side or the other to help you do that. And of course, I know those folks because that's who I partner with. When I meet CPAs or tax RIAs, at the end of the day, if you're an RIA, registered investment advisor, that doesn't engage in tax strategy, there's no fit for me, right? If there's a CPA that's just a tax preparer, there's no point in me even pursuing that relationship.
Right.
So they're definitely out there.
Yeah, they are. It's definitely hard to find though. Hard to find.
Not easy to find. They're not easy to find. And then of course, even there you have to understand what they're charging. And so usually you can find a lot of those guys on social media, because a lot of them do a lot of social media ads. About the tax advice. But you got to do your due diligence on, regardless of you're working with, whether it's an investment or a tax preparer. And then my only advice there as well is, there are a lot of tax strategies out there. One of your biggest questions you should always ask yourself and the person giving you the strategy is audit risk. And then you have to decide what is your level of comfortability with audit risk.
Yeah, no, 100%. Because no one wants to get audited. I mean, that is, I've never been audited.
No one wants to get audited, but there are a lot of people that are okay with the audit comes because they've pursued these. There's a lot of these strategies out there that offer multiples. You put in X and you get 5X. I've even seen 10X deals, man. You get 5X, 10X, 7X, put in $100,000, get a $500,000 deduction, put in $150,000, they're out there. There's a lot of tax strategies out there, and that's not that they're illegal, but all you got to do is Google the IRS dirty dozen list. That's one place to look to see what the IRS is looking at.
Yeah.
So just because you're on the dirty dozen list doesn't mean that it's an illegal tax strategy. It just means the IRS is going to look at those, which means the audit risk goes up. right? And anytime you have a deal that has a multiple, I'm just here to tell you, once you get past 3-to-1, especially, you're probably on the radar.
It's fascinating, man. Well, Steve, this has been like an awesome conversation. It's been great to kind of, get your perspective, honestly, because it's rare that I have an oil and gas guy on here, but it's there's a lot of crossover, right? There's a lot of crossover between what we do, and we all kind of fall into that same alts bucket, and kind of putting a bow on this too. Why is it that you think that, according to Preqin, the ultra wealthy currently have 40% of their net worth, or 40% of investable assets in alternatives? That number is projected to go to 50% by 2030, I believe. Why are we seeing more? And I know that you work with family offices too, right? So you work with some of these like higher net worth individuals. Like, why are we seeing more in like this flight to alts? What are some of the trends that you're seeing that are kind of pushing this movement forward?
I mean, I think it's alpha. I mean, alts are a way to generate alpha. I think that it is also a way to avoid the wild swings of the markets. And it's also, there's a lot of tax efficiency that can come along with alternative assets. So I think it's threefold for most of the, especially the family office folks. Obviously, they're investing large amounts of capital. And so, the alpha and the tax strategy are probably the two biggest ones when it comes to alts. So, look, oil and gas for example, oil and gas is not for everybody, right? I mean, alts are not for everybody. The biggest downside to alts is the lack of liquidity. So, it's not suitable for everybody. But if you're the ultra high net worth people in this world, in what call the country, the world, man, what is accessible to them is strategies, not only from an investment, but a tax planning strategy where they're just, this is why you get taxed the uber rich all you want. This on paper, they just find ways around it. I don't know how else to say it. They have access to stuff. I'm not talking about the 1%, man. We're talking about the 1% on the 1%, right? Right. They have so much money. They're not, you can put whatever you want in paper for tax code, and there's tax codes this high. There's always a way around it.
Right. 100%.
And if you've got the money to pay the people to find it, then it's all legal. It's not illegal, so you can't be mad at them, right? That's just the way it is. But I think alts are what is it? The Yale endowment fund is like 80% alternative assets. 80%.
Right.
So, unfortunately, most alts are not accessible to the average retail investor. But if you fall into that bucket of at least an accredited definition, then that world starts to open up to you.
100%. 100%. Yeah. Steve, this has been a super insightful conversation. So for those that are interested in learning how they could partner with you, how they could invest with you, we'll go ahead and link all of that in the show notes and in the description, assuming it's your website and whatnot, or any other ways that they can find you online aside from that.
I mean, you want to get into our current fund, you could go to our website, click on current opportunities. You want some further education, go to YouTube and type in Invito. I got a bunch of short videos that aren't about investing, but are purely just about navigating oil and gas investments. I always tell people they're good sleeping material. If you can't sleep at night, put me on talking about oil and gas, and you'll fall right to sleep. But I'm big on the education side of it. And I because it's not a suitable investment for everybody, but for certain people, it's a great strategy to have as part of your portfolio. Not only from an investment standpoint, but from a tax strategy standpoint. So, you can always reach us through the website, and I'm happy to ever get on a call with anybody, do a Zoom call, and walk people through it.
Love it, man. Well, before I let you go, in traditional Goldmine fashion, we're going to have you leave the audience with one final gold nugget. Take it away.
One final gold nugget. I would say the final gold nugget for anybody is the biggest liability on anybody, line item expense on an income statement for everybody is taxes in the IRS. So if you're not looking for strategies to reduce that, it's the biggest killer of net worth. So that's my nugget to you. That's why the ultra wealthy go to alts.
There we go. Love it. Love it. Love it. Love it. Steve, this has been awesome, man. Look forward to the next one.
Yeah. Thanks for having me on, man. It was a great time.